SEGRO jumped 16% on Wednesday after rejecting a $12.6 billion tower approach from U.S. logistics giant Prologis, which is the wrong reaction if you think the rejection ends the story. Prologis had offered 0.084 of its own shares per SEGRO share, implying 925 pence per share, a 24.6% premium to Tuesday's 742p close. SEGRO's board unanimously rejected it as opportunistically timed, and the market's immediate 16% surge to 864p is the data point that matters here. The bottleneck is the valuation gap between UK-listed and US-listed real estate, not the headline premium. Prologis's argument was that it could unlock SEGRO's embedded value better than SEGRO can alone. SEGRO's counter was that the bid was timed to exploit a temporary dislocation in UK and European REIT valuations caused by geopolitical events, the Iran war and Hormuz closure, that have compressed UK real estate multiples relative to their US peers. Both statements are factually grounded in the pool, but the 16% rally reveals that investors sided with Prologis's premise: SEGRO is undervalued, while simultaneously rejecting Prologis's price. That is the paradox the balance sheet data must resolve. The stock's 12-month range is 604p to 857p, meaning Wednesday's close near the top of that range arrived not on any improvement in SEGRO's own operations, but on the announcement that a rival values it at 925p. Something had to give in how the market was pricing SEGRO before this did, and what the board's rejection reveals about the structural cause of that discount is what drives the investment question. SEGRO's board did not reject the offer because Prologis is wrong about SEGRO's value. It rejected it because the structure of the offer means SEGRO shareholders bear the cost of the dislocation twice. Prologis disclosed a net debt-to-enterprise value ratio of 22% against SEGRO's 37%. That gap is not a coincidence. It is the direct consequence of the same geopolitical shock the board cited. When the Strait of Hormuz closed and UK inflation surged, UK REIT borrowing costs rose sharply. SEGRO's European portfolio, financed in sterling and euro debt markets, became more leveraged in market value terms, even without any new borrowing, as the asset values declined relative to US peers. Prologis, financed predominantly in dollar markets, faced no comparable compression. So when Prologis offered all shares rather than cash, it was using a currency, its own equity, that has been inflated by the same macro force that deflated SEGRO's. The exchange ratio of 0.084 Prologis shares per SEGRO share implies SEGRO shareholders would receive approximately 10.5% of the enlarged group. Yet SEGRO contributed roughly a third of Prologis's European portfolio value, a ratio that would close significantly if UK REIT multiples normalized. Invezz analysts publicly recommended buying SEGRO on the bid news, citing strategic optionality, the view that either a higher offer arrives or SEGRO's standalone plan re-rates the stock. SEGRO's board used the same underlying logic to reject: the clear dislocation between SEGRO's current share price and its highly attractive underlying business. The disagreement between Prologis, which is publicly urging SEGRO shareholders to override the board, and SEGRO's board is not about whether SEGRO is undervalued. It is about who captures the value when the dislocation closes. If SEGRO subs now at 925p, the recovery flows to Prologis shareholders. If SEGRO holds, the recovery flows to SEGRO shareholders, but only if the dislocation does close, and on a timeline that does not exhaust the balance sheet's capacity to fund the development pipeline. That is the unresolved tension. SEGRO's debt load is real, not merely a multiple illusion, and the rate environment that created the 37% net debt ratio has not reversed.
The variable that makes SEGRO's standalone case credible, and which Prologis explicitly cited as worth unlocking, is the data center development pipeline. Prologis stated that its global platform, balance sheet strength, and diversified capital base can unlock the significant embedded value of SEGRO's development and data center pipeline. SEGRO's board pointed to the same asset as its reason to hold firm, describing an exceptional data center platform alongside a large and attractive development pipeline as the value Prologis is attempting to acquire below intrinsic worth. The UK PMI data released the same day added a complication. Britain's composite PMI fell to 49.4 in June, a 14-month low, marking the second consecutive month of private sector contraction. A weakening UK economy pressures SEGRO's occupational markets, warehouse demand follows trade volumes, and slows the conversion of its development pipeline into contracted income. That is the counter-evidence against the standalone case. A board confident in its own value is also sitting in a contracting macro environment with a 37% leverage ratio and a development pipeline that needs both capital and tenants to realize its worth. Under UK takeover panel rules, Prologis must by 22 July 2026 either announce a firm intention to make an offer or confirm it will not proceed. The spread between 864p, where SEGRO closed Wednesday, and the 925p implied by the current Prologis offer is approximately 7%. That gap is the market's probability-weighted estimate of a sweetened bid arriving. For a current holder, the decision variable is whether a revised offer, one that prices the data center pipeline more fully, arrives by July 22, or whether Prologis walks and SEGRO drifts back toward the 742p it traded before this week. For a watcher considering entry at 864p, the question is whether the 7% spread to 925p justifies the binary risk of a Prologis walkaway. The balance sheet risk is real. If no offer arrives, SEGRO re-rates on its own fundamentals, which include a 37% net debt ratio in a rising rate environment and a PMI reading that signals softening demand for its warehouse assets. The critical watch is not the share price itself, but Prologis's public communications before July 22. Any language shift from compelling opportunity to silence would be the leading indicator of a walkaway, and the point at which the 925p implied value becomes irrelevant. SEGRO at 925p would be a premium to the EPRA net tangible asset value of 925p per share, reported at December 2025, meaning the board is not claiming Prologis undervalues the assets on paper, but that the development pipeline and data center optionality are worth more than the static balance sheet implies. That claim can only be verified by the standalone earnings the pipeline delivers, and the first meaningful read on that arrives well after the July 22 deadline. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.